Test.
They love Christmas. They love to celebrate. And so they give us new pronouncements right around Christmas time to make sure that the holiday cheer in my home is complete. So in 2017, I was actually taking my family to Hawaii for Christmas, which is great. And we're driving down the road and I start getting all these notifications that the IRS finally came through with tax reform, which they had really pushed through fast. We didn't think it would happen quite that quickly, but Merry Christmas, Mele Kalikimaka. We have tax reform, and so I spend a lot of time on the beach reading tax reform, which is even better than doing it on a Friday afternoon in the summer. But surprisingly enough, there were several elements that impacted exempt organizations, which I think to some extent we didn't quite expect to have this big of an impact. Unfortunately, a lot of those were revenue raisers because we had to score tax reform and make sure that it was revenue neutral or didn't, not neutral, but didn't go over the cap that they had set. So for any breaks that corporations, for example, got, they needed to find some revenue raisers. And interestingly enough, several of those came through in the not-for-profit area. So these were the big ones that impacted healthcare. UBTI on fringe benefits, mostly parking and qualified transportation benefits. We're going to now create phantom UBI. You didn't do anything, you didn't get any money, but because we took away a deduction from for-profit organizations, we're going to create income for you. Also, you like my silos for farm country. We've got siloing of unrelated business activities. And so we'll talk a little bit more about what that actually means. But instead of being able to offset your income and losses from different types of activities that are creating unrelated business income, you're now going to have to look at those separately and not be able to use losses from one business activity to offset gains from another, which is really interesting because if you're operating in the for-profit world, your business might be doing several different lines of business, and whatever your total activities are is what you report. But for not-for-profits, we're going to impose siloing. We'll talk a little bit more about that. The other two that we're not going to spend a lot of time on today, but just so we get kind of the whole world, is an excise tax imposed on highly compensated individuals, which does impact the healthcare community. There is a carve out for compensation for actual medical services, but as I'm sure many of you are aware, there's other compensation for administration and things like that that wouldn't be carved out. So that's another one. And then the one we spend a lot less time on is, it actually was an area that we expected maybe a little bit more in tax reform, but they did repeal advance refunding bonds for tax bonds that are advance refunded. So that was kind of the whole scope of it. We spent a lot of time talking about this. We got the laws, we got the changes without a lot of direction as to what it meant. And so for several months, actually for pretty much the next year, we were kind of scrambling around saying, what is this going to mean? Because most of them were going to be coming into play. We had statutes and they said these words, but when it comes down to how that's going to be applied, we didn't really know what to do. So again, as a Christmas present, at the end of 2018, we got a couple of other notices from the IRS. And so that's what I wanted to provide some updates on, because they did provide some really needed and useful additional guidance. In some cases, at least those of us that spend a lot of time in this, they kind of switched up the way that we thought things were going to be applied, and also raised some additional questions. So we're going to talk about some of those additional questions. It certainly cleared up a lot of kind of gray space, but raised some additional things that you may run into in your organizations. As we go along, if you have comments or questions, I mean, I'll give you time for questions, but please, we don't have a huge room. I don't think you're going to get too unruly. So please raise your hand, yell out questions. I'm happy to address them as we go. So the first thing I want to talk about is this first, got the P for parking there, qualified transportation fringe UBTI and the notice 2018-99. So notice 2018-99 was issued early in the month, so we could celebrate all month of December to provide guidance on how to apply the UBI created from qualified transportation benefits. So, and it's specific to the parking expense. So how many of the people in this room are aware of when I talk about UBTI for qualified transportation and parking, what I'm even referring to? Okay, we got a couple. Good. I'll explain it. Okay, so for organization, this is an interesting one because it applies to all businesses. It just applies a little bit differently to tax exempt, or the way that the calculation goes. So for time immemorial, employers have been able to provide parking for their employees on a pre-tax basis. So, and there's a limit to the amount. Currently, I think it's $260 a month, that if my employer were to provide a parking space for me, which they don't, but if they were to, which would be really nice in downtown Seattle, up to $260 of that would not have to be included as compensation to me every month. So if the value of what they were paying, that could be provided to me, or even I could pay it with pre-tax dollars, and the IRS is totally good with that. So when they were going through tax reform, they said, hey, there's a lot of revenue caught up in this, and Sue is not paying tax on that $260 if KPMG were giving it to her, which they're not, but if they were, but KPMG is taking a deduction for that, if they were, which they're not. But so that's reducing their taxable income, but we're not getting anything from Sue. So wow, we're having $260 a month drop through the cracks. And that's happening for all those employees at all these companies. That's a lot of money. So they said, you know what, great. You can continue, employer, to provide that for your employees. But we think if you're providing that and it's not being included in their compensation, they're not having to pay taxes on that, we're not going to give you a deduction for that, which kind of stinks. In the tax exempt world, we said, that's nice. We don't care if we get a deduction. You could take all our deductions away. We're not recording any income. We're not taking any deductions. You can take a deduction away from us and we don't really care. And they said, no, 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 no. We see your little game. And if you don't care if we take a deduction away from you because it's not changing your taxable income because you don't have any taxable income, we're going to create income. So instead of taking away the deduction, the other way to do that is to create UBI. So for that $260 that Sue's not getting taxed on, but you're providing a benefit for her, you're going to be taxed on that. We're going to call that UBI. We're going to create a new category of unrelated business income that's taxable to exempt organizations, and we're going to tax you on that, which kind of stinks, but it does keep all organizations on the same playing field. So that's the rationale behind it. Now we're all kind of up to speed. Okay, that's great if I'm paying $260 before tax, or even if they're paying a parking garage for me to do that and not including it in my income. But that's not how most employer-provided parking looks. Lots of times the employer has a lot that's next to their building, or they may provide a parking garage or something. So that becomes really complicated, both for a for-profit and not-for-profit organization. So the IRS gave us guidance as to how we're going to compute what that is. Now we're on the same page. It's not regulations. It's not final. What it provides is some background to the IRS's thinking, some things that you absolutely can't do, and some things that will be, if you follow the procedure that they outline in the notice, it's a safe harbor and it's been blessed. But it does say all along that any reasonable method can be used. So kind of keep that in mind. So first of all, the notice makes it very, very clear that if the employer pays a third party for their employees to park at that party's location, they pay a parking garage someplace, and don't tax the employees, so they don't include it in my compensation, the amount is UBI. There's no way around that. That's just going to be UBTI. If the amount that the employer pays to the third party is more than what the IRS's limitation, which is currently $260 a month, so let's say they have to pay $300 for parking in Seattle a month, which they probably would. The $260 would not have to go on my compensation, but there's no provision anywhere for that extra $40. So that's going to have to go in my compensation. So the $260 is going to be UBI. The $40 that goes in my compensation is just, I'm going to pay tax on that. It doesn't fall into that. So that part's pretty cut and dry. So that's the example. We'll go past that. So that part we can kind of set aside. And then they said, okay, if you own or lease the lot yourself, UBTI or UBIT. UBTI is unrelated business taxable income, and UBIT is unrelated business income tax. It's the actual tax on it. We use them interchangeably, but you can correct me if you'd like. So they say you can use any reasonable method, but we're going to give you a 4-step method that will be a safe harbor. This method will apply if you own even a portion of a parking structure or parking lot. If you own several, you can aggregate them within a single geographic area. They do use an example that a city is a single geographic area. They don't give a lot more guidance. So there's a little bit of a question as to if you're trying to aggregate, what can you set up as a single geographic area? We know we can rely on a city. I don't know if you can rely on certain neighborhoods. It needs to be a reasonable method, and you have some rationale behind it. And then this last bullet point, this really messed up my Christmas holidays last year, because this is what we thought we were going to be able to do. But they said using the value, whatever the fair market value of that employee parking is not a reasonable method. So you've got to use something other than just what the fair market value is. So that they did carve that out as an unreasonable method, which was really kind of painful when I thought I was being reasonable for the month before. So the 4-step method is based on the costs incurred, which quite frankly, in most of the situations that I've worked with clients on, the costs have been probably less than what the fair market value is. It may not be true for everybody, but at least it's something to hang your hats on. So the cost is where we start out. So the value of the parking, or what needs to be included as UBTI, is going to be based on the cost. And the cost can include all of these things. This is what's kind of called out in the notice. Probably the big ones are going to be rent or lease payments, maybe the taxes, insurance, repairs, maintenance. If there's other things associated, this is not exclusive, but it's a pretty good list. So the first questions that come up with that is, how do you determine? You probably have not been separately tracking all of the expenses for parking, your parking facilities. So how do you determine how much of general maintenance or utilities or tax, or even the portion of the rent or lease payment is actually attributable to that parking lot? And that's where we're going to come into using a reasonable method. Do we determine the amount of their rent or lease payment that's attributable to the parking lot as to the amount that someone would pay for those parking spaces? Now we're back to using the fair market value, which they said wasn't okay. Maybe it is. In that case, if you're saying it represents the portion of lease payments, but there's got to be a reasonable method. So what not to include in the cost that we're going to be allocating: depreciation and expenses for things surrounding it. So you don't have to pay for the landscaping that's not in the parking structure or parking lot, even if it kind of contributes to it. So you can exclude those sorts of things. Okay, so once you have your costs for parking, how much of that are we going to include? And that's what the 4-step method is. So you can see the steps here. We'll go through them one by one, but percentage of parking spots for employee use, you're going to look at that first, and then look at what the rest of it is generally used for. That may actually get you out of most of it, but if the remaining parking is primarily for employees, then you've got to look at, are there spots that are for non-employee use, and then allocate the rest of them. So let's look at how this really works. The first thing you do is find the number of spots that are reserved for employees. And this can be done by signage, by barriers. If you have, spray painted on it, reserved for employees, whatever it might be. So at the beginning of this year, 1/1/19, any method that is used that does not incorporate this first step is not going to be reasonable. So everybody's going to have to do this. So to the extent that you have parking spaces that are specifically identified as reserved for employees, any costs allocable to those spots are going to be deemed UBI. The percentage of them is going to be UBI. There was a provision at the beginning of this year, it's expired, but since we just have they gave you 3 months, that if you had a lot of signs up saying reserved parking for employees, just to make sure that your employees had lots of spots to park and they were never going to use them all. To avoid having to include all of those, they said, okay, you can go out there and clean up your parking lots, change your signage, and not have those reserved. But after that point in time, so let's say you still have those signs up and you go back on Monday morning and say, hey, we've got way too much parking for our employees. And Sue said, you don't want to do that and you want to go start taking down the signs. You can do that now, but you're going to have 8 months of the year with those in place. So just kind of something to consider. But to the extent that they are marked and set aside for employees, the costs allocable to those are going to be UBI. So some questions arise from that. What about spots that are reserved for employees during normal business hours, but your patients or visitors can use them in the off hours? Most of the language in the notice does talk about regular business hours, so it's probably employee use, but we'll get to this question later. What really are your business hours? For a hospital, is it 24 hours a day? I hope so, in the middle of the night. What about spots reserved for physicians? That can include both physicians that are employees of the hospital and physicians that have access and use that are not your employees. Are those really reserved for employees? There's not a good answer there. But it's an interesting question. Security employees, if they're reserved for security cars, that's not really the employee's personal car and they're not using it. That's probably not an employee, a designated reserved employee spot. Just probably would be taken out of the equation altogether. Okay, so you've done that. You've carved out those. Now we're going to look at what happens with the rest of the parking structure, parking lot. If the primary use of the remaining spots after you take out the reserved spots is to provide parking for the general public, you're done. You don't have to do anything else. And primary use is 50% or more. So once you've carved out your employee parking that's signed as reserved, look at the use during general business hours of the rest of the parking structures. And if more than 50% of that is for the general public, you don't have any more UBI to capture. You're done. It's tested during the normal hours of the organization's activities on a typical day. That can change, that can vary from the type of organization to type of organization. So you've got to, I would recommend documenting, especially if your normal business day is something other than 9 to 5 Monday through Friday, and you're relying on that to to not have to include anymore. I just document it. So what are the normal business hours? What's a single geographic location? Could you have multiple geographic locations within a city? Possibly. Do you have a hospital campus in one area and administrative offices in another area? It might make sense to have those actually be two separate business locations, geographic locations. This was interesting. How do you test the primary use where you have multiple tenants in a building? So and it's not specific, you don't have just, there's 3 tenants in a building and all of the employees can park anywhere. If you have a third of the parking structure or parking lot and it's mostly used by your employees, that's probably easy. But if it's the whole parking lot, your employees are only going to be using theoretically a third of it. Does that mean 2/3 of it is for the general public? It's kind of not, because it's for employees of the other organizations, but those aren't your employees. So it's an interesting question and there's not a good answer, but raise it so you have something to talk with your spouse about over dinner tonight. Okay, so you get through that. Now let's say that you carved out the reserve spots, and those are really only for, officers and directors of the organization, and the rest of us have to find someplace to park, and we're using more than 50% of the remaining spots, so you don't get to stop there. So now we're going to say, is there any parking that's reserved for non-employees? Visitor-only parking. Anything that has signage indicating that employees can't park there, you're not going to have any UBI related to that. So the third step is to carve those out, okay? You carved out the ones that were for employees. Now you've carved out the ones that are for, specifically if the employee parks there, they're in trouble. And the remaining locations, remaining spots, you've just got to go back to your analysis of how are those generally used. Are they generally used for the public? Is it 40, 60, whatever it might be, you're going to go and allocate those using any reasonable method and apply the costs, the percentage of the costs accordingly. Okay. You're all falling asleep. Let's go through a couple of examples to see how this actually applies, because this is where it actually gets interesting and where you're going to be doing it. So we have a tax-exempt organization. In this case, it's a university, and it has a bunch of surface parking lots. Universities are tough. They've got parking everywhere, and they've got signage everywhere. So the university includes, fortunately for us, who have to do math in our head, a nice round $100,000 of expenses. The parking lots have 5,000 spots, and they're used by students, visitors, and employees. They go and analyze their parking. 500 of the spots are reserved for executives and faculties, and there's about 1,000 employees parking in lots that are not reserved spots. So step one, how many reserved spots do we have? Because they've got 500 reserved spots for their employees. 500 divided by 5,000, we can do in our head, but it's up there, times 100,000, $10,000 of their $100,000 of parking expenses are going to be UBI. Okay, step two, let's look at the primary use of the rest of the spots. Well, only 1,000 employees are parking in those spots, so there's 4,500 remaining spots. 3,500 of those, or 78%, are used by the public or available for the public. So the primary use of the remaining spots, after you carve out the ones that are specifically identified, are for the general public, and we're done. So the only inclusion is going to be for the 10,000 of the reserve spots, and the 1,000 employees that are parking, we're not going to allocate anything to them because that's not the primary use of that spot. So that's actually a better result than we might have thought when we first got the tax reform information. Okay, let's do a little bit more involved. example. So in this case, we have another tax exempt organization. J is a religious organization. It operates a church and a school. And it has $10,000 of total parking expenses. By the way, these numbers are really small. I found that these parking expenses get big quick. So they have 500 spots that are used by congregants, students, visitors, and employees, and 10 spots are reserved for certain employees. During the normal hours, they usually have 50 employees parking in non-reserved spots and 440 non-reserved spots that are empty. So, and then during their normal activities on weekends, so we're looking at both of these, you can see the numbers there. So again, step one, we're going to carve out those 10 spots. We're going to have $200 of parking expenses that have to be included. In this case, the numbers work out really nicely for us, both during the weekday and during the weekends. Clearly, the majority are for the general public, so they don't have to include any more in UBI. Okay. This one gets a little bit tougher, and it's going to be confusing in the language that's used here, because remember, the law was written not just for exempt organizations, but for all organizations. So when I say deductible, that means not UBI. When I say non-deductible, that means UBI to you, okay? So in this case, a large manufacturer owns a bunch of parking lots and garages. They're in a big geographical area. And they choose to aggregate the spots in the lots and garages in City X. So we're just going to focus on City X. $50,000 of expenses. They have 10,000 spots in total, 500 spots reserved for management, and 8,000 employees that are parking in all of these other parking garages and parking lots. And they have 100 spots that are reserved for their visitors, suppliers, things like that. Okay, step one. 500 reserved spots for management. That's easy. We know they put signs there. We've got to carve that out to start out with. So $2,500 that's going to be UBI if we're an exempt organization. In this case, it's non-deductible for them. Okay, let's look at the rest of it. It's not to provide parking for the general public because they've got 8,000 employees parking in 9,500 spots. So 84% of those are being used by non-employees or by employees. So now we're going to have a bigger inclusion. 1% are reserved for non-employees. They have visitor parking written on them. And so the $500 that's allocable to those spots continues to be deductible because they're a manufacturer. If they were an exempt organization, it would be not included in your UBI. And then you've got to go back and say, what happens during your typical business hours? Well, in this case, 85.11% of the remaining spots, which is 8,000 divided by 400 of remaining spots, is used by their employees. So they've got to allocate another $40,000 if you're an exempt organization as UBI, or to them it's going to be non-deductible. So this takes you through the whole application. So again, if you go through that analysis and you don't think it's really representative, you can use another reasonable method, but you've got to, I would document that very well, but we know that we can rely on the four-step method. A couple of other things to consider. In the notice that came out right after that, they said, hey, we realize the law's been in place for a year. You're going to have to start paying taxes on this, next month. And we haven't really given you any time to work this out. So the fact that you didn't pay estimated payments to us when we didn't tell you how to compute estimated payments, we're not going to penalize you for that, which was really quite generous. And so it's not required if you meet all of these conditions. And to claim the waiver and say, don't give me a penalty because I didn't make estimated payments, you need to write notice 2018-100, which is a nice, easy one to remember. It's a nice round number on the top of your Form 990T when you file it. Okay. Any questions about qualified transportation or parking?
So Sue,
Yeah.
this sounds like a extremely complex process to something as simple as, hey, I'm gonna park my car.
Yes.
So did the IRS ever publicly state how much revenue they think they're generating by adding this complexity to something that you would have thought would have been super easy?
Super easy. I'm trying to remember exactly what it was scored at, because if you follow tax reform, every change had a score, and it was the dollars. This one was a pretty big revenue raiser because, again, it doesn't just apply to exempt organizations, it applies to everyone. And I'm trying to remember what the number actually was. Quite honestly, I think they might have gotten it a little bit low. But there's also been a lot of pushback, especially from the exempt sector, especially from organizations that have never paid tax before, never had any kind of UBI. And we heard, there were some rumblings for a while that we thought it might be overturned. It hasn't been, obviously, yet. But I think that what they're discovering is that the administrative cost that goes with it is probably a lot more burdensome than the actual revenue that they're getting from it. I don't know if we're going to see it change, if or when, but it has been one that's been pretty controversial. The difficult thing, and if we're talking more broadly about tax reform, is that it was done under budget reconciliation, so you had to meet the magic number. And because it was done under reconciliation and because it was forced through, Congress can't make any changes to it that have any revenue impact. So even if there were an error or an application that they didn't intend, if it has any impact on the revenue received by the government, if it's not revenue neutral, it can't be pushed through under reconciliation. It has to actually be voted on and agreed to by both parties, essentially. It's the way that things stand. And I don't know if anybody watches the news, but we're not getting a lot of compromise between Republicans and Democrats on really anything. So it's unlikely that that in the short term, many of the problems that have been uncovered through tax reform can actually be fixed, which is interesting.
Well, one thing I was thinking about is not just my work environment of what we have. I mean, at OHSU, obviously we have spaces, a lot of spaces, a lot of employees paying, park downtown versus park on the hill, and you get charged. So I mean, we have that. But then thinking about
a lot of discussions about the parking for OHSU.
We probably have a pretty complex scenario. So, but thinking about, the church that I go to, do they even know that this has happened, and have they, even started to think about it? I mean, or any other organizations that we're involved with that have a building and they have parking and they, have employee assigned parking versus open parking. I mean, how widely do people even know that this is out there? Because it just seems like it's one that, they logged in at the end, and it could have a lot of consequences. Is there a penalty if somebody doesn't comply?
Yes. Short answer is yes. There's always a penalty. So the answer to that question is yes, this is a shock to a lot of people, even not really tiny organizations. And yes, it applies to all of them. And the best answer is if you don't have, and for a lot of these organizations you ask, so for a tiny church, for example, they may not have an issue if you think about walking through these steps. Let's say they don't have any that are reserved for employees. Or maybe they have one or two. That's probably a pretty small number. And if it's primarily used by congregants, in this case, the public, so you go through step one and there's zero, right? There's nothing reserved. and you look at the use of the rest of the lot, and it really is visitors or the general public, it's going to be more than 50%, you're done. So yes, it applies to everyone. In a lot of these smaller situations, it may not be a big issue. I've run into a lot, and this is kind of tough, where it is a small organization, and they've got a little lot that's included in their lease, and they have 8 employees, and that's where the 8 employees park, and they've got, 12 spots in the lot. Yeah, they, in theory, have an inclusion. I haven't seen the IRS really going hard yet. Again, the answer is that yes, there's an exposure. I don't know how diligently they're going to try to go out and find all those little nits and gnats, and especially for somebody who's never filed an I-90T before, but they could. Yeah.
But your comment about, like, how much money they're really raising for the administrative burden. I mean, maybe it's a lot of money globally or, across the whole country for lots and lots of different organizations. But, I know a health system, they have like 20,000 employees, lots of parking, thousands and thousands of parking slots. I think they determined their estimated tax is like $15,000 to $20,000. They spent way more than that just researching this, just trying to figure it out. Maybe it's easier in years 2 and 3, but it's not. It seemed logically is like don't win raise money. But
globally, like, the revenue that they're raising from this is probably not coming from the tax exempt sector. I think that the pain is being felt here because they're creating income that never existed. If I'm a for-profit organization, I'm getting probably more of a deduction taken away because I'm providing parking for my employees. So, but it's interesting, and it'll be interesting to see if we see any developments, but I wouldn't expect things in the short term. Yes.
So does this inclusion as UBI for parking expenses also apply in areas where people don't even charge for parking? I guess I assume this was for, whether it's Portland.
And that's where it actually really hurt. Oh, sorry.
They are doing it online.
Oh, we are doing it online.
Yeah.
I'm not.
But you're close enough to that.
It's picking me up. Okay. So the question is, if you're just providing a parking lot and employees can park there, does this apply? We're not charging them anything. We're not paying a third party anything. Yes, I'm the angel of death. And
it's an area where there's typically not.
And
You don't charge for parking.
Yes, and that's the thing. So when I go back at the beginning here, back on slide, where does it say it?
Your list of costs.
Yeah, it was even before the list, the costs, but where it says using the value of employee parking to determine the inclusion is not a reasonable method. So I think a lot of us were saying, and this gets into a really nice debate, we're saying we're just going to use the fair market value. If there's no fair market value, if I could go across the street and park on the street and nobody would charge me, why would I not do that, right? So the way that the 4-step method applies, yes, because presumably you have costs associated with that. This is an area that accountants like to, we have a lot of fun debating this and thinking about it. And while I don't know that we've come to an official position, I don't think you could probably have a reasonable method where you say, this is imposed, this is maybe more than anybody wanted, but you ask the question so you get it. This is imposed under section 274. So these are deductions that are qualified. It's a qualified excludable benefit, or you don't have to include it in income because you're providing a benefit to the employee. So the question is, if there is no value to that parking, are you actually providing a benefit? And does it even ever enter into section 274? If it doesn't enter into 274, section 512A7 under tax reform wouldn't pull it in. It's an argument to be made. With the notice, I can see the IRS saying, clearly there's a benefit because you're incurring expenses. But that would be your argument, is to say those expenses were never under 274.
Right, we never
Yep.
include it as a fringe.
It's not a fringe benefit. They're not getting a qualified fringe benefit. So that would be the argument. All right, good question.
The whole thing's dumb, right? I mean, it's craziness for like what I would consider small dollars, lots of work, just to even prove that you don't really have to do something or pay anything.
I had one of my colleagues who doesn't work in the tax exempt area who stopped by my office just like 2 days ago. And he had gotten pulled into a discussion with a client of his on this issue and actually on the excise tax on excess compensation, which we're not spending a lot of time on. And he stopped by my office and said, "Do people hate you?" I didn't write the law, and I make that really clear, but yes, they don't really like me delivering the message. He's like, because I just spent the last hour debating this, and yes, welcome to my world. Okay, so the UBI siloing, we'll spend a little bit of time on this. This is another one that actually the information that we got in the notice that the IRS provided on this one helps us quite a bit. So the issue here is you have UBI that you've already been generating, and it might come from several different lines of business. And to the extent that you have several different lines of business, and this is something the IRS has really struggled with for a long time. They've tried to approach it because they feel like, I think, they're missing out on revenue here, because how are you allocating expenses to your streams of unrelated business income and generating losses? Do you have one thing that you're calling UBI that's generating a lot of loss that's then offsetting income from another line of unrelated business line? And so they've tried to look at this from the perspective of allocation of overhead expenses, identification of, they might say that a certain type of unrelated business is really subject to the hobby loss rules, so you're not ever going to generate income from it, so it should just be excluded. And finally, they've settled on this. You know what, we're not going to try and fight all those other battles, because quite honestly, they were losing battles, and especially if they were trying to apply the hobby loss rules, they really don't apply in the sphere, even though they tried to make them apply. So they said, you know what, we're going to say, you've got to look at each of those separate lines of business. And if it's truly a business and it's generating a loss now, it's going to generate income later, and we'll let you offset it later, but you can only offset it by losses that you generated in that line of business. So you've got to compute all of them separately, compute any gain, any loss or income. If you have a loss, you've got to spend that until you generate income from that line of business. Okay, in theory, that's great. We got it. And we said, what's a line of business? Like, that's the big question here. And we had no guidance on that. And it got a little bit terrifying, especially for those of you who have a lot of partnerships. Does anybody have partnerships, investment partnerships, alternative investments that you're getting a bunch of K1s from? So this is not uncommon in pension plans, you know, in your finance group, in the investments. Colleges and universities that have endowments have a lot of their investments in alternative investments. And in many cases, you're getting hundreds of K1s from different partnerships. So our question was, are each one of those a business? Do I now, in my pension plan or in my investment group, have 500 lines of business? Oh, by the way, it might be worse than that, because each of those partnerships are invested in different lines of business. So do you have to look through to those and do those separately? And by the way, the partnerships aren't providing us that information. And do I have to aggregate this partnership that has oil and gas with that partnership that has oil and gas? Or are those, there were a lot of questions. So the IRS did come in and provide some guidance for us in Notice 2018-67. So Congress, not surprisingly, in the course of doing tax reform, did not provide criteria. They said separate trader businesses, but they didn't say how we're going to determine that. So the Treasury, the notice first of all said, we intend to issue regulations on this. These are not regulations, but we're telling you we're working on it. Pending those proposed regulations, you may rely on a reasonable, good faith interpretation considering all facts and circumstances. Okay, again, not super helpful yet, but at least they're saying we recognize that you have no guidance. And then they said use of the 6-digit codes under the North American Industry Classification System, which is already in place in the tax returns, that will be considered until we give you better guidance. That will be considered a reasonable, good faith interpretation. So, okay, good. For the things that you're doing, the lines of business, you can use those. Okay, so the notice says those codes can be pretty broad or pretty narrow. They go from 2 digits, which are broad, to more specific. So they've asked for comments as to what level of specificity they need to use. Right now, we don't have that guidance. So if we look at some examples, you know, we have these, that's basically a 4-digit code there, or do we need to like drill down into these? But right now, these codes represent a reasonable good faith interpretation, and they haven't told us the level of detail you have to go down to. So as you're applying it in your organizations, you can feel comfortable relying on these codes, and at this point, I would document the level of detail that you're applying them. Okay. So for the partnerships, those codes don't really help us out very much. The IRS is very helpfully, in my opinion, said that they intend to propose regulations that will treat all investment activities as one trader business. Whew. Those 100 K1s can all be included together, probably, under certain requirements. So investment activities should capture only partnerships where the exempt organization does not significantly participate in the trader business. So these really need to be ones that you have just only have an investment purpose on. And so they're saying for right now, as an interim rule until we can get the proposed regulations together, if you can meet either a de minimis test or a control test, you can aggregate all of those together. So the de minimis test holds that the organization doesn't hold more than 2% of profits and interests, and it's important, no more than 2% of the capital interests. You cannot meet the de minimis test if the K1 you receive does not reflect your ownership on the face of the K1. So sometimes partnerships have gotten a little bit lax on that, or they keep it internally. So if you're wanting to rely on this, you want to ask your partnership provider to make sure that when they issue the K1, it's on the face of it. For the profits interest, for the capital interest, you can track that separately, but for the profits interest. One thing to consider, so you take the average, that's easy. The other thing that could be difficult is when you determine the percentage that you own, you also need to consider any interest held by a disqualified person. Generally, those are officers, directors, key employees, could also be closely related organizations, controlled entity. That's difficult to monitor. I don't know that you're getting the investment information from all your disqualified persons. So that's going to be a challenge. I think at a minimum, you need to show that you have procedures in place to try to get that information. Whether you truly know that you have it, I don't think an audit of all of your disqualified persons is required, but there needs to be a procedure to make sure that you've considered that. So that's the de minimis test. If they're all less than 2% of both profits and capital interest, can aggregate them together. If that doesn't work, you can also qualify under the control test. In that case, you can't own more than 20% of the capital interest, and you can't have any control over the organization. Again, you have to take into account any interest of a disqualified person in those percentages and in the control or influence. So you have control or influence if your organization or a disqualified person or the two of you together can require the partnership to do something or prevent the partnership from doing something. It's not clear if some standard approval rights that you have in your just ownership would trigger this. I think it might depend the level of what your rights are. If any of your officers, directors, trustees, or employees can participate in the management of that partnership, that would indicate control and fail this test. And if you or any disqualified person has the ability to appoint or remove any of the officers, directors, or employees of the partnership, that would indicate control. But if you meet both of those tests, you can aggregate all of those together. You can also aggregate all of the activities that the partnership, you don't have to try to look through into what the partnership is doing. So that hopefully takes away a lot of the potential headache that we were worried about. Then if it doesn't meet either of those tests, there are some transition rules. So if you owned the partnership prior to the issuance of this notice, every partnership interest, so the whole interest, the whole partnership, can be considered a trade or business. You don't have to look through to what the partnership is doing. It's unclear if you owned 40% of the partnership before August and you increase it to 80% or 50%, is that really considered a new partnership interest and you can't use the transition rules? That's unclear, but you can at least treat that partnership as a single trade or business. Under these, every directly owned partnership is treated as a separate trade or business, but you can't aggregate the separate partnerships together. However, if those partnerships are engaged in the same trade or business, those can be aggregated. So they can't be aggregated just because they're partnership interests, but if they're partnerships doing the same trade or business, they can be aggregated. And can be done by a reasonable method, which would include the NAICS codes. So a couple of other things to consider in interim. Qualified transportation benefits that we just talked about, parking, they're not considered a separate trade or business. So they can be combined. If you have losses from other trades or business, they can be combined with that. They're not considered a separate one. So if you only have one unrelated trade or business, let's say you just have a bunch of alternative investments that are generating losses and you have qualified transportation inclusion, those could be aggregated together. The IRS also said in this notice that they don't see a distinction, or they don't see it being a separate trade or business if you have amounts included in UBI from debt financed income, or 512B13, which is income from like interest from a related party transactions. And so they said they don't see really a distinction in those sorts of things. So in certain circumstances, I think they just kick the ball down the road. We don't really know to do these things. It might make sense just to put them all together and move on. So there is some justification if you have those to just group them together. This just talks about the instructions. How is this going to be administered? For every separate trade or business, there's going to be a Schedule M that's going to be included to report and track that income or loss from that trade or business. The charitable contributions, so if your organization is making charitable contributions, that can be applied to every trade or business until it's used up. So you can apply it, that doesn't have to be siloed, it can be applied to each of the trades or business. What becomes important here are the new NOL rules. So for net operating losses that are generated this is a change. In the past, we had alternative minimum tax and we had regular tax. And so under the alternative minimum tax regime, you were limited on your NOLs. For regular tax, you weren't. They got rid of AMT and then limited losses in the regular tax. So in my mind, they kind of kept an AMT element just moved into regular tax. So you can only, after 12/31/17, you can only offset up to 80% of your income with NOLs. But now the NOLs don't expire. They used to expire after 20 years. So, and you can't carry them back. What becomes interesting is the effective date is for losses that arise after 12/31/17. But, let's see, get this right. But the limitation is only for years beginning after 12/31/18. Anyhow, there's a mismatch, sorry. So this is, this is what can happen if you have, let me get back here. So if you have a fiscal year organization ending after 12/31/17, the NOLs that are generated in that year are not subject to the 80% limitation, but they can be carried forward indefinitely. So it ends up with a little bit of a mismatch there. It actually could end up in the taxpayer's favor. They haven't addressed that in this notice. The other thing that happens in this is that they do indicate that the losses that are generated currently would be used before the pre-2018 NOLs, and those ones can expire. So you have to use up the more recently generated NOLs before you can dip into the old NOLs. So that could end up with some NOLs expiring, and it violates what usually is the first in, first out principle. That may be cleaned up in the final or in the proposed regulations. We really don't know. The other thing is pre-2018 NOLs can be offset against any silo. So those are what I call good NOLs, and you can use them until they're used up against any income. Okay, I think we've actually covered most of these questions. One thing, what do we do if we acquire an organization that has existing NOLs? Can we fit those into a silo that we have, or do they become their own silo? We don't know that. I would say right now, if we're using those NAICS codes, you probably, if you have overlapping codes, you probably can put them together, but we don't have specific guidance on those. What happens when the organization sells an unrelated trade or business? You free up those NOLs. At that point, can they be used against other lines of business? We don't know that either. I think I'm not going to go through this. One thing to consider with the effect on financial statements, in the past, we've had valuation allowances for these NOLs, and if we didn't think that the organization as a whole was really going to be generating income, we didn't worry about it too much. It was just going to be generating losses. Now those need to be looked at on a silo by silo basis and may really change the way that we've been treating those on the financial statements. So, time to questions. I know it's a lot of information and it's almost lunchtime. Questions?
All right, I think we're ready for Drew.
I think we're ready for Drew.
All right.
Yeah.
There you go.
We get to wear that. Good, switch this thing.
Okay. Okay. Take that also.
I can just start talking.
Yeah, go ahead.
All right. Well, I'm not going to keep you guys past noon, so we'll do this efficiently. This is the last thing, right? When this is done, this is done. So I'm between you guys and lunch or the road or whatever it is. I think I've met most of you guys, but if I haven't, my name is Drew Corrigan. I'm in the audit practice for KPMG, and I get to lead that group for the Pacific Northwest. I spent a lot of time in Seattle and Portland and a little bit of Utah and some California, so we kind of have a West Coast team. And have gotten a chance to work with most every provider kind of in this area that's 100 hospitals or 100 beds or bigger for the most part. But what I wanted to talk about a little bit, I've spent tons of time talking about revenue standard and lease stuff and no accounting today. So today is just about kind of business risk and what's going on in the world. And with some of the things with technological innovation and just pace of change and things like that, again, since I do financial audits and things like that, we're kind of seeing like the burn rate of the impacts on finance functions and ability to kind of digest and keep up with all of it is kind of a weird crossroads of things. I know organizations are trying to implement a lot of new things, but one thing that KPMG did just this past few months, we released a couple of surveys that we did. So I'm going to start with kind of some just general business stuff and then kind of hone in more specific on healthcare. My first slide here, is it kind of need to scroll it down more? But this is a slide that is basically the kinds of challenges that the audit committees, again, this is a survey of 200 audit committee members across the country in all kinds of businesses, and the sorts of things that are causing them issues and their core function. Normally they're in charge of like dealing with financial statements, internal controls, oversight of external auditors. But one of the biggest things that they're all saying these days that they're spending a lot of time on is helping the organization just deal with the talent for the finance function. I think you guys probably all deal with it. It's always fun and challenging and kind of a pain in the rear to recruit people that are going to be a good fit. They have the right skills, fit with your culture, things like that. That still ends up in being one of the top things that they're worrying about. Let's see. One of the things that is more of a you want to click it again to see if it does look good. Yeah, it's getting most of it. I mean, I guess let's see if I do it again. Well, I see it's kind of a, well, one thing that I just wanted to point out here is this managing or monitoring fraud risk, and boards obviously deal with this. I had an interesting thing that I saw presented at an audit committee recently where the CFO was talking about the kinds of challenges. Again, there's not a lot of big ticket frauds that normally happen. When they do, they're obviously headliner type things. But if this organization had 20,000 employees and they said, probably 80% of their employees, really like working there, they're on the same page, they're all trying to work towards the mission, maybe 15 to 20% of the people are just kind of there for a job and all that. But he said, unfortunately, even though, we think we have great screening and all this stuff, there's probably 0.5% or 1% or whatever people that are actually in our walls working here, collecting a paycheck, that are kind of actively working against us. And so when you think about that, if you have 20,000 people, that's 200 people that are probably doing bad stuff, whether it's visible or not, and just having ways as, boards and kind of management to be able to kind of ferret this stuff out. That's a, bigger risk, I think, than, really, they kind of wanted to. Just they kind of digging into this, they're feeling like they need to do a better job of managing that. The last thing on the bottom, you might not be able to see it, but one other thing, it has really no impact to you all if you're not in the public company space, which we're all not-for-profits, but critical audit matters. The only reason I wanted to bring this up is a lot of things that happen in the SEC environment a lot of times make their way to everybody else at some point in the near future. This is a new thing that public companies are having to put in their audit opinions just starting now, is what they call them critical audit matters. Basically, they're wanting auditors to actually have more emphasis in their opinion and actual description of how they've assessed the biggest and most important risks to an organization when they actually sign off on a public company audit. And their expectation is at least one of those will show up for every company. And if you have a big deal or something, there might be multiple, they can come and go, but you have to have at least one of them. And so this year is the first year if you start seeing financial reports or annual reports of companies, they're going to look a little bit different. So that's a new thing, and who knows, maybe it'll impact our industry someday too. I talked about impact of the finance group. But anyhow, these are some of the responses from committee members around changes in technology as it impacts the finance function. This says 27% plans to leverage robotics or something like that in their finance function or within the organization now or in the near term. I've actually had a handful of clients calling me within the last year where they're wanting to talk to us about the things that they're doing in the organization around that. And so we're trying to figure out, what is actually that impact of the downstream to the financial statements? Does it change the risk? Should we be auditing differently? Things like that. But that's definitely, a big change in the world. And I think some of those, bots is a fancy name for a macro sometimes, but sometimes it's just machine learning, and then they're doing a lot of these high volume, low dollar processing type things in a way that, again, as auditors on our side, we have to kind of be thinking about those things differently. And as business people, the organizations are going to have to manage that. But I imagine that's going to be just more and more organizations kind of getting into that. So that's kind of a new one. Let's see. Well, I guess the other thing I kind of skipped over because the top got cut off is, again, with the whole notion of like the shortage of great people to hire, as these things are all changing so fast, the kinds of skills that you need on your team is going to be changing quite a bit too. So governance is probably worrying quite a bit about that. That's why they put 71% have been focused on leadership and the ability to kind of evolve that. Let's see, other priorities that these organizations are thinking about. Cybersecurity, obviously that's big in healthcare, it's big in all business. 2 out of 3 board members cited that as one of the bigger items. Data privacy and protection was only 25%. I think this was all healthcare companies. That'd probably be a lot higher, given the nature of our regulatory responsibility and just the sensitivity of the data that's in there. Let's see. The other thing, I guess, too, getting back to the people side of it, I don't know how robust the succession planning is in the finance function of your organizations, but it's pretty hard to have a deep bench when you're in an industry that's got challenges on margin and increased pressures. But the other reality is, having a good succession plan is actually really important, but it's getting harder and harder to do that. One, you get limited ability to finance that, and also just a lack of supply. This slide here and kind of the next couple kind of gets more into another survey we did. Again, this is not about audit committees or boards anymore. This is more just talking to CEOs. I think we interviewed 400 CEOs around the country, and these ones were not picking multiple things. They had to choose one thing they thought would be the most significant threats of actual growth of their organization. So again, this whole thing about changes in technology and disruption and things like that was deemed to be the #1 item. There must have been a bank or two in the population because interest rate risk is on there as well, which I don't know who else would pick that as a actual threat to the growth of their organization. Cybersecurity is high on the list. It's interesting though, when it came to CEOs and to the talent risk, if they were looking internal to their organization, I was really surprised to see that so low as it relates to that part of their organization. I don't know, anybody have any observations or kind of reactions to any of that?
The talent risk was the one I was going to mention, because in their previous slides, it showed that was viewed by, the audit committee and so forth as being a much higher risk, where the CEO is putting it at 3%. So that's super interesting. But if they only had one that they could pick versus if you said pick your top 5, maybe it would have been in the top 5.
It could be, or board members' view on the outside looking in is a little different in terms of there's no CEOs in this room, right? We can make fun of them. Maybe they think, hey, I got the best team, it's all good, don't worry about it. sure I'm being a little crass in that, but I think it's probably a combination of things. But, again, if you're going to pick one thing that's going to threaten your growth, maybe they're choosing more kind of a technology disruption and stuff like that. Down at the bottom, I don't know if you can quite see it, but it says 77% of US CEOs believe they could significantly improve the understanding of their customers, which, again, I'm sort of a little bit surprised to say that. I mean, they're willing to admit that, 70 out of 400 CEOs of large organizations, they really don't understand their customer, or if the dynamics of the changing appetites of their customers over time, they can't keep up with it, so it's really hard to do. They want to do that better. The other one on the right side, 81% feel personally responsible for understanding. I had to remind myself what ESG is. I think it says environmental, social, and governance. Basically, it's the sustainability and ethical impact of things that they feel a responsibility of trying to get into their customers' heads, and what do they think about that, and try to make their organization kind of match that. This is a healthcare specific survey result, just current trends and challenges, achieving scale for the short or long-term view. Then this is just my personal opinion. I'm not trying to make fun of any organization or anything, but you see a lot of the mergers and just affiliation activity that's happened over the last, 5-7 years, something like that. Some of the biggest of the big health systems in the country seem to be struggling the worst in terms of actual financial performance. So, maybe long way of saying that they haven't yet proven that bigger is better. I mean, I don't know if you guys, Common Spirit's the new name of the Dignity Health and Catholic Health initiatives. They're newly combined, but their first year together results to date so far have been pretty atrocious in what's been kind of released out there. And I know it's probably turning 2 battleships that for different markets and getting those things on the same page. I can't imagine trying to do that. I mean, they were individually $20 billion organizations, and they have 2 CEOs that are both still there. So, I'd love to play referee on that. But I imagine one will emerge at some point. But anyhow, that's that one. Growth and innovation, a lot of larger systems are spending a certain amount of their dollars in innovation and growth, trying to find other ways to produce a bottom line. Again, it's kind of hard to invest in that, though, if you don't have your core operations producing enough, which has been challenging. Current challenges, kind of different lens of looking at this. I think a lot of people seem to think that we're probably inching towards a recession. Hard to know. Things are kind of seeming to slow down a little bit, but a lot of the CEOs, I think, were anticipating that sometime in 19, maybe 2021, that we'll probably experience that, which always makes, getting funding even more challenging. Let's see. And then this one's going to get cut in half. So I have a top 10 current emerging risks for healthcare. I guess number 1, the cyber, privacy, and security. Pop up so we can see most of the rest of the list. But one of the ones that I've been kind of seeing a little bit, and I don't know where it'll really go, but number 4, assuring the integrity of quality reporting. I mean, you guys experienced some of this, and I know that the health plans in the region, graded on this quite a lot. It's more and more the payments are based on quality metrics and things like that. And we're in my organization in the business of issuing audit opinions over financial statements, and the world of accounting, there's a lot of controls and things like that. And for public companies, opinions over the internal control over financial reporting. We don't know where it's going to go necessarily, but as more and more of the government's money is tied to actual metrics around quality, how those metrics are reported and the quality controls around those is completely different. We've done a few pilot studies at some health systems in the West, and we kind of teamed up together to kind of study this and learn a little bit. And the number of metrics, it's always changing. It's a lot of metrics that they're actually reimbursing based on your results on that. And especially if you're penalized because somebody else is reporting something else, but it's not really good data, how are they going to do that? So anyhow, we think that that's likely a trend as more and more money is going in that direction. And again, I don't know if auditors are able to do anything, but at least the government's probably going to get more interested in seeing how you're developing all that information to drive that. Anything on this list that's surprising, or you're seeing that you're not seeing that you would have thought would have been kind of out there? Again, this is more from our healthcare friends that have kind of helped us develop this list.
I think we spend a lot of time on number 8, especially the last 2 words, that coding integrity.
Coding integrity.
When you think about all of the other risks that are out there, we spend a lot of time in that avenue of, making sure that we're coding it right, that we're getting documentation right so that we can bill. But to me, there's so many other risks out there that maybe we're not focusing on as much.
And maybe the integrity around it, and again, it's not the same thing, but number 4 on that quality reporting thing, again, we're such compliance-oriented organizations, and the industry has so much of the different ways we get looked at, that there's probably some consistency in terms of the skills and things like that. Number 9, the governing joint ventures, partnerships, customer experience, and Sue was talking about the partnerships more from an investment standpoint, alternatives, things like that. But these would be more, if you have an imaging joint venture or all these other, what percentage of your actual net income these days is coming from core operations versus some of these other ventures you might have with physicians or other types of organizations? It's some organizations that it's a lot in terms of actually where the earnings are coming from. Yet that may be an entity that you have very little oversight over, or the ability to actually influence how things are working. So that's, kind of creates some challenges as well. Talent, these ones aren't in an order by like best to worst, biggest, smallest, things like that. So I just inherited the slide the way it was. It's based on just the accumulation of things. If something falls off, we kind of evolve this list from time to time. Things come and go as life evolves as well. One other thing that isn't specific to healthcare, but I see come up with healthcare a little bit more often, and this I wouldn't necessarily call a business risk per se, but does anybody know what a SOC 1 report is, or they used to call them SAS 70 audits, but if you have a service organization doing something for you outside of your walls, but it's technically basically an extension of you and your control environment. There's, we do these as an audit firm, like all the firms do these as part of this. The service organization wants to be able to provide that to their customers to be able to give them the sense of that, these controls are good. Well, short answer is there have been more and more challenges with entities being able to pass those kinds of audits. So when you as the customer receive them, it's like, oh, I have this massive process. They have an outsourced claims processing on a health plan or something. If you get a SOC 1 report with an adverse opinion on February 10th and you're trying to issue financial statements in March, what do you do with that? And that's been happening a little bit here and there. We also see it happening in the employee benefit plan space too, where you have a record keeper, again, doing a really important function for that particular entity. And the audits of those plans rely on those managements using them for all kinds of things. If they flunk their IT controls or something like that, which happens more often in today's world than it used to. So this is, the only reason I bring that on is be alert to that. So one, you should make sure you have an inventory, remember who your service providers are, and how are things going with their controls and things like that. Because a lot of times you kind of sign up, you have a good contract, they have a good reputation, you sort of autopilot with that. These are, some of these places are companies that have been around for decades and decades, and all of a sudden out of nowhere, something didn't, they had an upgrade in their IT department, something got messed up, and boom, big time problem. So I didn't want to leave that slide without mentioning that. It is noon, so I'm just going to kind of touch on a couple things. This will be fun. We're going to have some elections and stuff coming up. It'll be really interesting. This is not political day for me. I'm not going to reveal anything as to what I think about, unless I slip. But a lot of the Democrat candidates are talking about this whole Medicare for all. What are different ways to get more people covered? last go around, we ended up going from Republican House, Republican Senate and Republican President to now it's the House, right? That's now Democrat. And we're going to have an election in a little over a year, and that could change. So say we have all D, some of this stuff's probably going to happen, because this seems to be what a lot of the candidates are really discussing on the Democrat side of things. So again, these are all different ways that you could have this happen. Apparently our buddy Bernie Sanders is really into kind of pushing this kind of Medicare for all, which again, I think is a way for people that say normally you have to be 65 to get Medicare, that there'd be a way to maybe buy in to say if you're 50 to 65 and can actually be part of that overall program. Again, I don't know how that would work if like employers would get in on it or whatever. I mean, there's kind of some craziness that would have to happen here. And there's one comment on here that I want to make sure to say before I go home is when there's a Congressional Budget Office has some things about this thing, if we go to single payer, what that might look like. And again, most of us here in this room are hospital people. It says hospital or reliance on Medicare pricing will cripple hospitals and providers. I think that's the biggest statement in the world. I mean, it's like, if you look across our entire country and everybody went to Medicare rates, we'd have negative earnings all over the place, because we all know how much the commercial side of things really helps things ultimately work. And so, notion that there'll have to be some sort of like, revamping of things and making things work clearly is going to be a major overhaul. And I think that like there could be some sort of disruption or whatever transitional problems. I call it a massive understatement of what would ultimately happen for all of us to have to deal with. And then the last thing, you guys have heard kind of like, this is cut off again, but the move kind of going from, volume to value, again, starting to pick up more pace. I think people are, and some more and more contracts are kind of being set up that way. You guys probably see it a lot closer than I do, but it's kind of nice though, because of the disasters that happened in the late 90s, early 2000s around, up and downside risk and risk pools and all that stuff that, I think nobody was really capitalized very well for it and understand it very well. It seems like the kinds of things that people are setting up, I think, are much better understood and working a lot better in today's world than they used to be. But I moved really quickly through all this stuff, so I apologize for being so fast. But is there anything you guys want to talk about or ask before we kind of call it noon and say, go for it?
Anybody have any questions?
Well, I appreciate you guys being the ones who have been willing to stay till noon on the sunny day.